recording. I want to welcome everybody to the this market review of the art and science of active trend trading. I'm Dennis Wilburn, the founder and head technician for the art for active trend trading, and I'm glad you joined us today. We're just going to take a real quick look at what the market's doing. We'll keep this really brief and short. I'm going to be looking at just basically 5 different stocks and a little bit of a covering for some tech, for a technical analysis and some tech talk. So let's get going here. There we go. Okay, I want to again welcome the Art and Science of Active Trend Trading update. I'm Dennis Wilburn, the founder. I want to remind everybody that all materials that are presented are for training purposes only. Traders should always pay per trade any new method prior to the risk of their own personal capital. I want to thank you for joining us today. If you like the content, do me a favor. Like us on both Facebook. This will be posted later on YouTube. Like us there too, make a couple of comments. And if you have any questions about what we are covering, please engage, and so we can chat about that. Today's Art and Science of Active Trend Trading update, I want to take a look at the weekly update video that accompanies the newsletter that's posted to our website. You just need to be a free member of Active Trend Trading to get access to that particular point on our website. Market technicals, we'll take a look at, do we have anything going with LABU or LABD? And then other market driving events. Today was Cyber Monday. Sales from Black Friday were exceptionally strong. In some cases, some companies showing sales 25% greater than they were last year. That shows a very strong economy. However, will that translate to keep the market continuing to go up? The market seems really trying, like it. The index is also, just very briefly. And then the technical mechanical tip that I'm going to be doing today is just, we have to make a decision when we have been in a downtrend like the markets have been in for the last several months. Are we going to, one, trade counter trend, that is basically try to pick the bottom and trade back up into a reversion to the mean type of trade, or are we just going to stick with the trend and trade to the downside once we do get that pull up? So let's ask a couple of questions. Okay, one, trade counter trend or with the trend? Counter trends, reversion to the mean. What that means basically is you found a level of support. The market, the index, or the entity you're looking at trading has found a level of support, and then it is basically bouncing from that support, and you're anticipating it moving up to one of the moving averages, i.e. the mean. Or do you want to basically trade with the trend? If the longer term trend is down, you wait for the reversion of the mean, and then reversion to the mean, and then trade basically with the stronger trend as it moves back down. In this case, if you're trading with the downtrend. So let's check out NDX and QQQ. There's a really good example here. I'm basically going to kill my video for just a moment. I'm going to show you this. Okay. And we'll just go to QQQ. You can see that very nicely. And I'll show it to you here on the weekly, daily chart, which is on the right-hand side. Let me get rid of that particular. And what we have going on here, get rid of that, is we are in a downtrend. The downtrend in the Q started around the first part of October 2018, and we see what happened. It thrust down, recovered up, thrust down, reacted up, and we moved right up into the 820, 200, and 34 moving averages, busting above the 8. Now, are we getting a reversion to the mean? As you can see, over the last couple of weeks, what has happened is there we go. You can see over the last couple of weeks, the 8-day moving average has contained the price action, and we move right up into that today and bounce. Now, is this a reaction from the mean? or a reversion to the mean? We've hit to the 8-day, or is it going to revert on back to the 20, which is a stronger reversion? And oftentimes traders will trade against the 20-day, which we see here, 20 or 21-day, or we have these stronger even moving averages up here at the 34 and the 50, and they coincide a lot with this downtrend. So we may be seeing a reversion. It gets all the way actually back up to the downtrend before turning back over. So the question we have to, in answering the question, do we trade with the reversion to the mean? Well, we can, but at every time we can do that, but we want to know how much can we expect to move. So reversion to the 8-day would give us about a 3.6% gain, up to the 20, where we'll probably be over the next couple of days, 5%. Up to the 34, we're looking at about 7%. Multiply that times the, just take that and roll that over into like TQQ, which is the leveraged ETF for the NASDAQ. And we'll see, we could run, if we ran all the way back up to, I'll just draw this line here from where it's at right now. Let's say we just take out and get it back up to this moving average. From where it's at from where it started back here, we would be looking at about a 22% gain. If it was just to the 20-day, about a 17, 18% gain. And so we have to make up our mind. Is that worth the trouble, or is that worth the risk moving on up into those levels? And so there's where's the price actions coming down. And again, it's already started up into its move. We did get some nice crossovers here on a daily chart. Looks like the weekly is trying to do something, but we just don't know yet whether or not that's the case. We did get a nice little gap up. If we get more follow through, we get back up above the 8-day moving average, that may give us an indication that, we are moving higher. So the other option, of course, is to wait for this action to happen. Basically, let it get back up to whatever means it's going to revert to. Put in topping candlesticks and topping reversal patterns, and then trade it back the other side. Because the expectation is that you'll trade back down to the lower level of this channel. These lows here form the bottom part of the channel, which would put us down to about, how far? About $37 for TQQ. And on QQQ, you can just leave that in there. You'll see that it's, not quite, but a reversion down to the mean would put us down to about 154, 153. So that's the question we all have to answer at this point. Does it look like we are going to continue to move up? Right now, we are still in a downtrend on the indexes. So, okay, let's take a quick look at some of the other things we're looking at, and then we'll call it a day. We'll keep this really brief and short. Let's take a look at one of the stocks that we've been looking at is Paycom. Paycom just had it, more or less had its guts ripped out. It had moved down to a level of support down here, almost like a capitulation move to the downside, spiked down on this would have been the 21st. Wait a second. There's the 20th. On the 20th, ripped down 21st, 23rd, and the day has moved higher. Let's keep our eye on Paycom, and also with any stock that you may be looking at, keep an eye on what's going on with the volume. If the volume is basically lower than normal, lower than average, and it's popping back up, reversion to the mean, in this case, since it isn't a downtrend, we have to be aware of, if it reverts to the mean of these three moving averages up here, which is the 50, the 34, and the 200, and reverses, that may give us a chance to basically trade Paycom to the downside. If we get up there it reverses off of those level, pulls back a little bit, and then pops up. Then we'll be able to look at, hey, we have a bottom in place on Paycom. The other one we want to look at is gold, or GLD, excuse me. GLD. GLD is really being challenged right now. We are back up against this downtrend line that you see here on a weekly chart, and it's basically respecting this downtrend line. It is below the 40-week moving average, which corresponds to the 200-day moving average. It's below that. You can see that right there. And so we can anticipate if we break back down through the 50 and the 34, then we're probably going to go all the way back out to 114 to 113.50 or even lower. There is some discussion about gold running into and starting to trade in lockstep with the dollar, which it hasn't done in quite a while. But if the global economy does start to falter and that kind of stuff, oftentimes you will see gold and the dollar link up and move in the same direction, simply because people are looking for safe havens for their funds. So gold, not a lot to do right now. If we break back down, look for it to continue pressing downward. It is respecting this downtrend line that is just below the 200-day moving average. The other one is our buddy oil. And you can trade various entities on oil. One of the things I like about oil is that it does a couple of things for us. One, you can trade, there we go. You can trade UCO. This is the bullish side of oil. USO, which is also, this is the non-leverage ETF. And as you can see, it has been in a downtrend the same way oil has been for quite some time. And it didn't get much of a relief pop today. It looks like it's trying to, but it just hasn't really kicked off and done that very well yet. Though if you're looking at trading the leveraged ETFs, as a two-time leveraged ETF, seems like this is the better of the of what's out there, because I've been looking for a three-time leverage ETF on oil and just not finding anything that trades enough daily volume. So this is a two-time leverage, which is fine, and it trades on average about the average there is about that much, about a little over 3 million shares per day. Whip over here to its inverse, SCO, and again, SCO looks to be topping out, but it may also just be pausing. So we'll just look at what we're doing with oil as we move forward. So those are some of the things we're watching this week. Let's move back to the presentation. One of the questions came up this week from a member is that what trend, has the uptrend been broken? Well, the answer to that question is, well, it depends on what uptrend you're looking at. This is the SPY on a monthly chart. And I want to thank stockchart.com. This was posted on their website, and it was excellent. It shows that back in 2009, we went into a secular bull market. That is still in effect. That uptrend is still heading up. Then we went into a little bit of consolidation back in 2015, 2016. And then we broke out of that and went into a new cyclical bear market to the, basically pushing up. And this was an accelerated rate. And so this was higher velocity than the velocity that we see here for the longer term secular bull. And we have broken down below the trend line here. So oftentimes what you'll see is a breakdown below the trend line, a move up to kiss the trend line goodbye, and then a fall. If we fall, there's a couple of places. One, we know we have good support about 250. We also know that, hey, we could in fact go all the way down here, 210 or even 200, or this 220 line right here, which constitutes the secular bull market. So the cyclical bull market could go into becoming a bear market. It could become a bear market while within the uptrend of the secular market. So I wanted to share that with you really quick. Here's another thing to just keep in mind as the market looks like it continues to weaken up a little bit, and that's that, you know, bulls and bears, this goes back to 1930, shows an average of how long the bulls lasted, how long the bears lasted. And the longest bear market during that time frame was back in the 1930s, 2.8 years is how long the bear market lasted. What we want to do is, you know, if we're still young enough to take advantage of this. If we go into a bear market and it pulls back for 2 or even 3, close to 3 years, we want to be ready to position ourselves at the end of that and trade back to the other side. The other thing to remember is that counter trend trades on the indexes during a bear market oftentimes have larger swings to the upside than the upside swings you will get during a bull market. Okay, you'll see that we have posted onto the website. After this recording is edited, we will have our watch list up to date on that line, and just a couple of other things that I want to bring into focus. We are in the November-October timeframe, and the November-December timeframe. Look what tends to happen with oil. Part of what we're seeing with oil right now is, yes, worldwide economic driven, but also part of the seasonality of it, which tends to go down in November and continue to push down. So some of this from all the way from October. That corresponds pretty good with the downtrend that we saw in oil that started around the 1st of October. Russell, we're here. We're in November. We'd like to see a little bit of a bounce. We'll see if this is the one. Stand by. I apologize to everybody on MAPS. It is coming in December. We had some marketing issues that we're trying to work through, and we got those just about done. So we'll be launching this in December. For people who are non-EWA members, that's early warning alert members, early warning alert members can convert right now over to the MAPS. Backtested results were less whipsaw, more trades. Okay. And last but not least, going into the new year, we will be having an increase in our pricing for active trend trading premium membership. So you can take advantage right now. I don't know how long this is going to last. It may be through just through November or into the first part of December, but you can take advantage of, save 40% off the $74.99 regular monthly membership. Get it for $44.99. Get all the bonus. Get all the alerts. Get all the tracking, and you just sign up here at that website. Use this password, bonus, BONUS. And I think that basically brings us to the end of today. I want to thank you all again for being with us. And I will click on that and say aloha. Thanks a lot. And in those buttons down on the bottom, please click the thumbs up. God bless everybody. Aloha.